Hello CQA judges, this is Rensselaer Team 1, representing the Lally School of Management. I'd like to thank Dr. Aparna Gupta, Dr. Chanika Edura Singh, and Mr. Pankaj Patel, who have been our mentors. My name is Stephen Romano, and I am the Chief Investment Officer.
My name is Beck Zhu, and I'm Chief Compliance Officer, as well as the Industry Analyst.
I'm Zhicheng Liu, I'm the Fundamental Analyst.
I'm Yangpu, the Portfolio Manager.
I'm Yulan Yang, the Quantitative Analyst.
I'm going to cover the agenda for our presentation. First, I'm going to look into our investment strategy. Then we'll move on to our adjustment strategy, which we did on a weekly basis. Then we'll dig into our portfolio's performance, our top gainers and losers, and end with a risk analysis of our portfolio before we cover additional changes that we want to make to our strategy. So for our investment strategy, each team member was assigned 200 stocks from our stock list and was tasked with analyzing them on key ratios. The book value of the company was used as a determinator of value when compared against the company's market price. Additionally, the price to earnings ratio was used as a way to predict potential growth or potential decline. Dividend yield for each stock was used to show if a stock had a consistent revenue stream for investors or if there would be a predictable movement in stock price due to dividend payments. So here I have just a screen capture of the spreadsheet that we use for picking stocks, and each ratio was listed and ranked accordingly. From here, each team member chose approximately 40 stocks to go long or short in, with at least 20 long and 20 short to use in our model. Then our model used historical data to create a minimum variance portfolio. We used daily data over a 3-month period to calculate beta for use in the model.
So the first thing we normally did when adjusting our positions was to run the program. We adjusted the time period of the historic data used when running the model each week. For example, if the market environment is fluctuating, we would have a short time period for about 2 months. Inversely, when the market is on an apparent trend, either up or down, we would have a longer time period of about 3 to 6 months. This is the data we poured out every time we did the adjustment from the CQA Challenge platform. First of all, we ranked the profit and loss percentage for all the positions and tagged them with action needed. As you can see from the slides, then we put our attention to the stocks who are over 10% either up or down. The next step is comparing the positions of the tagged stocks to the weights we got from the model results. For the stock which has consistent weights from both places, we leave it. For the stock which doesn't have the same weight from the model, we would do further research to decide where it would go. The research of the stocks are focused on special events. We were trying to figure out the drivers for large changes in the stock price. Then we can decide to keep it or sell it or add more money to it. Technical analysis is also an important factor when making the decision. The technical tool we used are 5-day, 1 month, and 1 year chart. Normally, we would invest in a new stock which had a large weight in the model result and at its low point from technical analysis. Also, specific events for the companies, such as acquisitions or mergers, could also affect our decision making.
Our portfolio beat the benchmark so far. By December 27th, we outperformed the SPY by 20.53%. From February 3rd to February 6th, when SPY raised 1.16%, our portfolio dropped 3.15% due to negative beta. Most of our top losers were generated this time. We did not adjust our portfolio in that 2 weeks, which also contributed to this result. We were not sure about the direction of further market movement, which is a key factor to set our model and make adjustments. Most profits were made from October to December, when market was performing poorly. That was a perfect state for the functioning of our model, which relies on a constant direction. Another company, Tesla, got acquired during this period, and we realized the profit instantly after the acquisition came true, and it is the largest percentage gain of our portfolio. For losing positions, we decided to hold them if the model told us to do so. If not, we are realizing the losses over 10% and substitute them with others.
Here we have the risk analysis for our portfolio. These ratios were taken on February 12, 2019. The alpha is 1.68%. Our beta is negative 0.18. The Sharpe ratio is 2.10, and our total risk is 14.73%. Here's a chart for our largest risk contributors. As you can see, it was very volatile. The percentage active risks range from 10.15% to 21.82%. At the top of our list, we have Adient PLC. On the right side of the chart, there's the MCAR. This stands for the marginal contribution to active risk. This is used by multiplying each security's net weight with the MCAR, and that way we will receive each security's contribution to predicted active risk. Here's a chart for our smallest risk contributors. The percentage of active risk ranges from negative 3.79% to negative 7.55%. The smallest risk contributor is Netflix Inc., and as you can tell, the active weight was also 7.86% respectively. Here is the active risk factor by group. This is a time series of our risk. The majority of our factor risk came from specific and market factor tilts. This is the active style factor exposures chart. On this chart, there's a consistent exposure between value, volatility, and growth. This relates to the early chart as for the drivers for risk.
The beta of our portfolio is changing based on our projection of further movement of the market. At the beginning of the challenge, we set a negative but close to zero beta, focusing the market going down. The portfolio was profiting in the first 2 months when the S&P 500 index had a negative return. Initially, we determined that the market is still going down and keep a negative beta. But when the markets recovered in January, we failed to adjust our portfolio, which caused the portfolio to suffer a loss. In conclusion, the strategy of our adjustment is reasonable, but we needed to make adjustments more often to reflect changes in the market. Also, we needed to be more flexible about the adjustment rules. For example, we set the criteria of making adjustment to when a single stock's profit and loss is above 10%, but we will lose loss of profit if we take actions immediately. For flexibility, we took action based on current market and deep analysis. We will re-evaluate our portfolio and change our objective function to match the current change of the market. We should change our strategy and monitor our portfolio's beta more frequently to ensure that our portfolio stays on track.